Hello everybody, James Cards FC here. Thank you for checking out another video of mine. Apologies to my soccer exclusive audience, but today I'm going to be discussing something that relates more to the sports card market as a whole than specifically to the soccer market. So if that interests you, feel free to stick around. If you just want to see some more soccer content, I would recommend you still watch, but you can probably go ahead and skip this one as I will not be talking about soccer at all in this presentation specifically. So today, we're going to be talking about an idea I had when I was looking at an article recently about the dot-com bubble. And I'm going to ask the question, did the sports card market experience its dot-com bubble in the past couple of years, and what this could mean for the future of our market going forward? So, appreciate you guys checking out this video. I apologize in advance as the slides do not have many pictures on them. We'll be talking about a lot of things in theory and some history. So if you want to put this on in the background and just listen to it more in podcast form, totally acceptable for this one. I won't be going through very many charts and graphs or pictures. So again, appreciate you guys checking this out. Let's get started. If I can get the slides to change, of course. There we go. So let's talk about the dot-com bubble briefly. So in the late 1990s to early 2000s in the United States, the new rapidly growing internet created a buzz among speculative investors, leading money to pour into startup tech/internet companies. Many of these companies were able to raise money to go public without a business plan, product, or track record of profits because of the hype that was brought by this new internet that people thought was, and actually ended up being a life-changing piece of technology. So the majority of these startups that raised money went public and folded, resulting in a market crash that took over a decade to fully recover. The NASDAQ composite itself fell by 75% from its peak in 2000 to its low in 2002. For my international viewers, the NASDAQ is a composite of some of the top stocks in the United States. So all the top stocks fell collectively 75% from their peak in 2000 to a low in 2002. This was caused by a market-wide overvaluation of internet firms relative to their intrinsic value. And we'll go into a little more detail about that in the next slide. Okay, so this is a graph of the dot-com bubble. This starts in January of 1998, and you can see this massive spike here. It goes from around 1,500 to 5K in just a few years, so it more than triples in just a few years' time. Has an all-time closing of just about 5,000 in March of 2000, bottoms out in October of 2002, and then it continues its slow rise back up. Here comes the housing crisis in late 2009, and then comes back up and up and up and up and up until it regains the 4,000 level in 2013, and then finally closes again at 5K in March of 15. So it takes almost exactly a decade for the NASDAQ composite to recover from the dot-com bubble. 15 years to reach its previous high. So the three of the main factors that led to this dot-com bubble. The first one is overvaluation of companies. Anything in quotes I took directly from the article that I was reading. So analysts did not focus on the fundamental analysis of these startup businesses, and revenue generation capability was overlooked as the focus was on website traffic metrics without value addition. So translating this into more common speak, analysts ignored fundamentals and used faulty new metrics with no historical precedent. Sound familiar? Abundance of venture capital. So venture capitalists and other investors poured money into tech startups, and cheap funds were relatively easily attainable through low interest rates at the time. There were also few barriers for startups to acquire this money. There was also a media frenzy. So media companies encouraged people to invest in risky tech stocks by peddling overly optimistic expectations on future returns and the get big fast mantra. This should sound familiar as well. Business publications such as the Wall Street Journal, Forbes, Bloomberg, and many investment analysis publications spurred demand through their media outlets, adding fuel to a burning fire and further inflating the bubble. Again, this is probably starting to sound familiar if you are in cards from the years of 2019 to current 2022. So with that background on the dot-com bubble out of the way, let's move into the COVID boom or sports card bubble. So, moving my camera over here. I tried to summarize this in as few points as possible. There were a lot of things that happened here, but this is my basic summary of the COVID boom sports card bubble. In late 2019 to early 2020, sports cards began seeing increased capital and interest, spurred by a variety of factors. This ranged from Gary Vee pumping them like crazy on social media, posting about them daily, hourly. He was really into sports cards, and he has a massive audience, brought a lot of people to the market. There were these exciting new rookie classes, Trae Young and Luka being the clear, obvious example, really got the basketball market jump started, which led to people flooding into the other markets as well. And then Zion the next year brought a ton of hype as well. So really exciting rookie classes coming forward. Social media influence is going wild on these things. And we have this powder keg, basically, and it starts rising, and it's heating up into late 2019 and early 2020. So it's not only caused by the COVID stuff. This was a powder keg that just kept building and building and building as we got into early 2020. So moving forward, COVID lockdowns in early 2020 led to many people being stuck at home without work. With no live sports on TV, ESPN releases a Michael Jordan documentary that becomes a national phenomenon and reignites interest in Michael Jordan cards. The reason the Jordan documentary was a national phenomenon was the fact that there was no alternatives. Live television was severely hurting at the time, live sports especially. There was nothing you could watch at this time, and so ESPN fast-tracked this documentary they were working on because there was no live sports, and it was a massive success because people treated this like a live sporting event when they were viewing it. So this is massive. It reignites interest in Michael Jordan cards, and obviously what comes from that is following the massive Jordan price increases, all segments of the sports card market see a massive surge in demand, unlike anything seen before. Among the popular investment options, investors flock to easily understandable base cards of highly speculative players in hopes of capturing massive overnight returns. The NBA bubble heavily fuels this. So, people will give you this example all the time. You could have bought a Bol Prism card for $2 to $3, and after a scrimmage game in which he scored like 10 points and had a couple highlights, those jumped to $30 or $40 overnight based on one night of performance. So there was massive speculating going on, and we still see speculation in the market today, but to this extent was unheard of that things were 10xing overnight, and it was not uncommon for this to happen. Every other night there was a new card that 5 to 10x'd. It was just a matter of which one it was going to be. There was so much interest and so much speculating. This was insane. So the bull run continues into early 2021 as the Michael Jordan rookie reaches a record price of over $700K at auction. This happens, I believe, in December of 2020, and this continues to fuel a fire into February/March of 2021 as people see this record price. So the bubble then bursts as the old money holders of skyrocketing assets sell off their positions to new investors. Specifically in the case of Jordan, anybody that bought under that $700K mark, and most people bought under a $20, $30K mark, see this $700K auction and say to themselves, I would be fine at that number, I'd be fine at half that number, I'd probably be fine at $100K. So all of those people now want to sell their positions in order to capitalize on this massive auction. So as a result of that, too much supply comes to the market, sending prices tumbling back down, and the Jordan now consistently sells in the $250K to $300K range rather than this $700K range that it was at the top. Okay. Is this the COVID boom bubble? So these are the best graphs that I could come up with. On the left-hand side, you have the Michael Jordan 1986 Fleer in PSA 10. This is its full pricing history. So this thing was sitting around, I believe it's 5K in this range, and slowly grows its way up to 20K. Then this right here is the Michael Jordan documentary. It goes from 20K to 100K in a matter of a few weeks, before sliding back down into the, I believe this is the more 50K range, and it sits there for a little while. Then more hype, more influence, keeps pumping the market all the way to this peak up here at around 700K in, again, late 2020, early 2021. And from there, it has slowly detracted down to what seems to be its new leveled off price at 250K. This is Card Ladder's low-end index. This tracks all cards under $500 on their platform. This would be a lot lower if they didn't include the $500 part of the range. If this only included the $1 to $100 range, this would look dramatically different, but they don't do that, probably because it would look so terrible. But in any case, this is what happened to the low-end cards. They start really skyrocketing here in mid-2020, carries all the way through to late 2020, then they follow the Jordan sale in the general market in early 2021. This is as, again, the basketball season's getting underway and things like that, pump this market further, and then it starts tailing off as interest wanes. Again, if this was tracking cards under $100, this would look a lot lower now than this currently looks, but Card Ladder does not show that, so we're stuck with this as an example. Okay. 3 factors that led to the COVID boom. This should start sounding really similar to what we saw on the 3 factors that were in the dot-com bubble slides. So, number 1 is the overvaluation of cards. Analysts, in this case, the analysts are us, retail investor types. Analysts ignored fundamentals while counting on new money and demand to continue fueling a never-ending bull run. So, a quote here that I remember from a very prominent member of the sports card industry said the following: "Do you know how many Celtics fans there are?" in response to base Jason Tatum's unsustainable rise in price. So, base Prism Jason Tatums are starting to go up crazy in price. People start pointing out the fact that, hey, these are base cards. This is getting pretty crazy. And I remember in response, a very prominent figure in the market quoted, "Do you know how many Celtics fans there are in relation to this price increase," assuming that all of those fans, or a large percentage of those fans, would also eventually come into cards as well. So, next point, abundance of capital. Retail investors receive historically high amounts of disposable income in the form of enhanced unemployment benefits and stimulus checks as a result of COVID. So I'm specifically talking about the United States in this case, but I'm fairly sure that stimulus was given out in other countries around the globe as well. If you look at graphs, there was no disposable income was at its highest point, I think, in recorded history during the pandemic as a result of all this money being printed and pumped into our system. So that more disposable income, less places to spend it because you can't go out to eat, you can't go to amusement parks, you can't go on vacations, you're stuck at home. So there's less alternatives for that spending. You have more money than you've ever had. So putting it in sports cards made a lot of sense, especially when that asset class kept pumping and pumping and pumping and pumping, and you could easily double, triple, quadruple your money in a few weeks just based off the demand that kept surging. So institutional money sees this increased demand, and they start to inject their own capital into the system as well, and this further fuels things. It's also super easy to buy cards. You could go on eBay and do it. There was a plethora of marketplaces to do this on, but it was super easy to deploy capital into this system. Then the last point here is social media frenzy. Sports card content on YouTube and Instagram explodes in both supply and consumption. Again, people are at home with nothing to do. They start getting into sports cards, and there is a massive amount of content out there being made on YouTube and Instagram. Instagram people are flexing these massive returns they're getting. YouTube people are talking about prices going up like crazy and what you should be buying and selling and all this. And so people consume that sort of content. Continues adding fuel to the fire. Mainstream media also reports on record prices, and celebrities start entering the market, and this all leads to increased investor confidence. You would see this all the time posted on Instagram. Blank is now in cards. Fill that in with whatever celebrity or institution you want to put in there. They're now in cards. Was posted whenever a famous person or famous company posted anything having to do with cards. It could have been base cards. It could have been literally anything. If a celebrity posted a card, didn't matter what it was, everybody assumes they're now in cards, and investor confidence continues and continues and continues. So these are 3 factors that led to the COVID bubble boom in the sports card market. All right, now we'll start talking about the aftermath of these bubbles. So, for the dot-com bubble, it took 15 years for the market to fully recover to its previous high. Only 2 of the top 15 NASDAQ stocks in 2020 had a positive return during that 15-year period. 50% of the NASDAQ 100 stocks from 2000 have positive returns today. So, half the top 100 NASDAQ stocks from 2000, when the market crashed, only half of them have positive returns. The other half, you are still in the red on. Even if you held for 20 plus years, you would still be in the red. So, internet/tech startups are now much better understood from a valuation perspective as we've learned more about the internet and technology, and fundamental analysis is much improved, but still not perfect. There are still imperfections in our market in terms of valuation for these types of companies. Last point here, a few of the rare dot-com bubble stars become some of the biggest companies in the world. Apple and Amazon are two of these. So despite the fact that this market completely crashes and there are a ton of losers, there are a few absolutely massive winners in the long run. And with that, we will pivot to the aftermath of the COVID bubble boom, or the COVID boom bubble in sports cards. The Michael Jordan Fleer 1986 PSA 10 seems to have bottomed out at 65% of its previous high. The NASDAQ bottomed out at 70% in 2002, so that's a nice parallel there in regards to how much this bottoming out point was at. Once the bull run ended in the sports card market, many speculators left the market, specifically the flippers that were in it, to make quick returns on their money. They left as soon as the bear run began to start in early 2021. So, highly speculative base cards also continue to drop in value as populations increase while demand decreases. The remaining investors are moving to cards with better fundamentals because they realize that fundamentals actually do matter, especially in bear runs as opposed to bull runs. Last point here is interesting. The ultra high end of the market continues to thrive and see record pricing, and institutional capital continues to be deployed. You see this in terms of institutional money going to grading companies. Fanatics is buying up pretty much the entire sports card industry. eBay continues to invest in their sports card infrastructure. We could go down the list of examples, but institutional capital is continuing to be deployed into this market despite the crash that we are currently in. So, wrapping this all up, what this could mean for the future of sports cards. These are the points that I came up with. The point number one is that it may take over a decade for the overall market to reach its previous high. Now, I know that we have a lot of institutional money coming into the market, but if we learn from the previous example of the dot-com bubble, when things crash, it takes a really long time in most cases for things to get back to the previous highs that they were at, because those previous highs were unrealistic based on fundamentals for the market at the time. So this is not a hard and fast rule, but it may take over a decade for us to see those previous record highs for a lot of these cards. So this leads into point number two, which is that many cards, especially those with bad fundamentals, will never return to their all-time highs, and in some cases will drop to $0. So your Bol base prisms, your Kobe White base prisms, these cards were hundreds of dollars during the COVID boom. And I think it is likely that in the future these cards will be worth $0, especially in base PSA 9 or base PSA 10, because the population reports will be so high. Bol will likely be paying in China or Turkey, and Kobe White will end up doing the same, or being an end-of-the-bench player in his NBA career, and nobody will want to invest in his base cards. So, on the other hand, we will have a again, this is all personal methodology and personal opinion. A very few select cards will return to and exceed their all-time highs, and some may become insanely valuable. This is what happens in the dot-com bubble. The few companies that survive end up in this tech startup space end up becoming massive and some of the biggest companies in the world. So Amazon, Apple, we might see some of these cards that survive this end up becoming the Amazon and Apple of our market. So, more speculative cards prospects could begin to trade closer to their fundamental value as the majority of the popular prospects of the COVID boom era fail in the next decade. Again, this is some of my personal opinion, but similar to how in the dot-com bubble startups failed, in cards, we're going to see massive failure rate as well, but it's going to take longer for this to play out because players' careers are going to take multiple years, whereas in the dot-com bubble, these new startup companies ran out of money almost immediately as they went public. So this will be a slower burn, but very similar to the fact that we are going to see a lot of failure for a lot of the more speculative plays in the market that happened over the past couple of years. And with that, we'll get to my takeaways and final conclusions. So, Based on this information, it would be my recommendation that you avoid investing in speculative prospect cards. Not only are they likely to fail, but interest in prospects could decline over the next decade as more examples fail. So, not even talking about Luka Doncic level players, but Trae Young, for example, Bol, Kobe White, all these kinds of guys, 99% of them are likely to fail and end up being worth absolutely nothing. And as this continues to play out, speculators will continue to lose money. And I think in general, the market will become smarter because of this and pivot to things with better fundamentals and avoid these speculative plays. I think they will still be made, but I think I think it will be at a lesser extent than it is right now, as we have more examples of how much money ended up being lost on these guys. For example, if Zion completely fails, that is going to have a massive effect on the market just due to the sheer amount of money that was pumped into his market during the COVID boom. So, with that being said, I would try and target the blue chips in the market with good fundamentals that may one day become our Amazon or Apple over the next 20 years. But don't reach for these. There's probably time. It took Amazon and Apple many years to become these massive companies. And like I said before, only 2 of the top 15 NASDAQ stocks in 2000 saw positive returns 15 years later. So you probably have some time to try and go hunting for these grails that may end up being worth insane amounts in the future. Understand, this is point number 3, understand that it is likely we see, it is unlikely that we see massive overnight increases in cards again. I don't think we will ever see a time in the market in the future where, based on the results of a scrimmage, a player's base card will jump from a couple dollars to $30, $40 overnight. That is a once-in-a-lifetime event, in my opinion, and I don't think that will be coming back. So, similar to the dot-com bubble, where the new internet caused a once-in-a-lifetime event, there was no dot-com bubble 2. This did not repeat. The stock market, it did crash again, did grow and then crash again with the housing market, but it was to a much lesser extent than what happened in the dot-com bubble. So this was a once-in-a-lifetime sort of scenario, and I'm equating the COVID boom that we just recently saw in sports cards similar to this. I say here, there's likely no COVID boom 2, even with all the money being pumped in by these institutional investors and fanatics. I think it's unlikely that we see a massive meteoric rise over such a short-term period. And part of this is because over the past few years, I'm not sure that based on our current market, if somebody wanted to get into sports cards, they wouldn't have already done it. You had every reason to do so. Media pumping it. You probably talked to your friends about it. If you were making money, you were probably making tons of money. You would have told your friends. Everybody would have gotten involved. And so I think we're reached a plateau there in that February point, and it's only downwards from here until the long run slow build brings us back up to our previous highs, very similar to the dot-com bubble. So, last point here, and I think this is important. Given that we are unlikely to see such massive price spikes in the future, reflect on the fun that you had during the bull run, the friends you made, and enjoy collecting things you like. This is very important. I think people are really starting to come to terms with the fact that this was a once-in-a-lifetime bull run kind of event. It was a heck of a lot of fun if you were involved in it, as long as you didn't spend all your money on speculative base cards. Even then, you probably had a lot of fun doing that, as long as you didn't spend beyond your means. A lot of friends were made, and now it's possible that in the future, even the near future with Fanatics coming in, we see some spikes come up in terms of pricing, but I personally would rather focus on just enjoying collecting and things you like. Don't worry so much about the massive price swings, because I think those days are behind us. This is going to get back to being more of a niche hobby, in my opinion, that may attract a few more people in a wider audience, but I think the amount of money being injected into the system all at once was a once-in-a-lifetime sort of opportunity. So with that in mind, create some Grail goals, enjoy collecting what you like, and have some fun in the market. So that will reach the end of my presentation here. If you made it all the way through, I thank you so much. I had a lot of fun actually putting this together, looking at the COVID boom in its comparisons to the dot-com bubble that happened in 2000. I think the similarities are there, And I am not a doomsdayer. I don't think our market is going to zero. I just think it is realistic to assume that this crash will not correct back to its previous highs for a very, very long time. I would love to be proven wrong, and I would love if fanatics and a massive wave of institutional money and a new massive wave of people start coming into the hobby all at once. That would be great. It's possible. It's on the board of outcomes. But I definitely would not base my purchase decisions on that being a 100% given. So do with that information what you will. I hope you enjoyed today's video. Thank you so much again for watching. Go ahead and hit subscribe if you want to see more content like this. Leave a comment down below. To my soccer exclusive watchers, I apologize that this doesn't cover specifically soccer, but I think this is an important video as we understand what point in the market we're in right now and how this may impact things going forward. So enough rambling. Thank you guys so much for watching, and I will see you in the next video.